All right, welcome to chapter 12. All right, the last chapter in Accounting 201. And so I do intend to start and stop these things so that they're not all a solid 2-hour lecture video. And so I'll just break them into components. And so the first part of the chapter, we're going to be talking about the characteristics of sole proprietor partnership, limited liability companies. I definitely encourage you guys to read that because I'm just doing an overview, all right? Because my hope is we did talk about this way back at the beginning of the semester when we were talking about business forms. And there are other classes that you talk about, the characteristics of a proprietorship, or a lot of people refer to that as a sole proprietor, meaning one person. And that's what we've been doing this whole semester. We've been talking about Chris Clark and his company, Net Solutions. We took his Net Solutions from a service business into a merchandising business. In Accounting 202, we're going to be talking about corporations, and we're going to be talking also about manufacturers. So that reminds me, right, to say a little something about summer, all right? So you guys in Accounting 201 are kind of off the normal track, all right? Normally when people come in their freshman year, they're supposed to take Accounting 201 in the fall and then 202 in the spring, right? And it's set up that way so that if you decide to choose accounting as your major, and I hope you really do consider that, that is set up for intermediate accounting one that is only offered in the fall, all right? And so, you guys are kind of a little bit off track where, if you wanted to be an accounting major and you didn't take Accounting 202 in the summer, you would have to wait a whole year until you took intermediate one, or it's Accounting 211, in the fall of 2021, all right? And so I really want to encourage you guys, if you guys are thinking at all, even if you decide to change your major later, which is fine because Accounting 201 and 202 are required for all business majors, I really encourage you guys to consider taking Accounting 202 this summer, all right? Several things. First of all, I would be your teacher. The other thing, and I don't know if that's a good thing or a bad thing, the other thing is that it's completely online, all right? We will have Zoom meetings. However, I intend to have all the videos up as far as the lecture videos, and you can access those, and we'll use the time in class to work problems, answer questions, and things along that line. The other thing is that the summer session is only 8 weeks long, right? And so, yeah, it's more streamlined and it's a lot faster. So I just put that out there. If at all you're thinking about maybe going into accounting, I really encourage you guys to take Accounting 202 in the summer. All right, with that being said, moving on, all right. We're then going to talk about how to form a partnership, all right, and an LLC, all right. Then we're going to talk about how to add partners. Okay, then we're going to talk about liquidating a partnership, and then we're going to be talking about the dissolving of a partnership, all right. Well, I'm sorry, dissolving and then liquidation, all right. And so, yeah, and we're not going to talk about this, all right. Cross that out. I think that's just a stupid little ratio. I mean, you can look at it, but it's not going to be on the exam at all. All right. So, yeah, the different types of businesses that can, we can have sole proprietor, and that's really what we've been talking about in Accounting 201. Okay, we're going to talk about this Accounting 202. Okay, I'm sorry, this is 201 also. Woo, see what I'm writing. Okay, so that's what we're going to talk about today. Really, this is actually a question I ask you next semester also, is the only thing that is different between a sole proprietor and a partnership are the equity transactions. Every day-to-day journal entry is the same, whether it's a sole proprietor, partnership, corporation, LLC, S Corp, all right? There's different ones that we really don't talk about, all right? The day-to-day journal entries are all the same. The only thing that is different is how do we deal with the equity section. Right? And this is an accounting 202, right? And this is 201. Okay, we're just going to briefly talk about the LLCs, right? And so a proprietorship, right, like we talked about, is owned by a single individual, Chris Clark, all right, Tony Moniz, right? Most common proprietorships are professional services, such as lawyers, architects, realtors, you know, and so on. Know that the bulk of business forms are sole proprietor. However, they only do something like 20% of all revenues or, you know, cash sales, right? Whereas corporations and other forms do the bulk of the dollars, all right? Even though there's fewer corporations, right, they do more money than sole proprietors do. Okay. Partnerships, okay, is an association of two or more persons who own and manage a business for profit. All right, and so I've been told, all right, that if you're trying to decide to get into a business with somebody else, you need to really know that person, because it's very similar to a marriage. All right, you guys are going to have some of the same characteristics where you share assets. All right, and you know, you really want to make sure that you guys are on the same table or are in the same mindset. All right, partnerships are less widely used than sole proprietors. Okay, you know, but it is one that we need to talk about. But we're only taking one chapter to talk about them. All right, and so the characteristics, all right, they're relatively easy to form. Okay, thing here is that you want to make sure, all right, that you you know, you formulate a partnership agreement. That's kind of like the contract. Hang on a second while I had some blinging over here, so I want to make sure that everybody is here. All right, cool. Well, I'm assuming that whatever, maybe somebody left already. All right. Every time somebody comes or goes into the class, my computer does a little bling in sound, and you know, whatever. But yeah, so the partnership agreement, if I ever ask you, okay, you know, how would you do something? You always want to go back to this partnership agreement. All right. It tells you things like, you know, who gets what, all right, as far as if you guys are making money, and, you know, how things are handled if there's a disagreement, right, things along that line. Okay. One of the downsides of a partnership, all right, is that there's, you know, unlimited liability, all right, and so really what that means, okay, is if, you know, you, your partner, or even one of your employees does something wrong, right? Maybe they hit somebody on their delivery truck, all right, while they're texting their, you know, the family or the person who was hit can sue the business out of existence, all right? And so, you know, if you're in the business of making t-shirts, they could sue all the assets of that t-shirt company. However, if they don't feel that they have been compensated, right, for their injuries, they can then also sue you as an individual, and they can take your personal assets, all right? And so that's why we've come up with these things called LLCs, and we have corporations where those have limited liability, all right? And all that means is same scenario. The person who is injured or the family that remains, they can sue the business out of existence, but they can't come after your personal assets. Right? Partnerships and LLCs are not taxable. Okay, very similar to a sole proprietor. Everything flows down, all right, to this thing called a Schedule C. All right. Okay. On the individual's tax return. All right, and so you know, the business does not pay the tax; the owners pay tax. Okay. Next characteristic: limited life. All right. You know, whenever a partner comes or goes, or is added or removed from the partnership, the old partnership, and this terminology is important, is dissolved, and a new partnership is created. And so, again, let's just say that we have a lawn care business, all right, and there's several of us that are part of that, and one person wants to leave and do their own thing, all right. Well, what happens is the business is still cutting yards, all right, cutting lawns and trimming trees or whatever, all right. That the business doesn't stop, all right, but the legal form of the business is dissolved and a new partnership is created, right? And so that's really a limited life. So hang on, I'm adding somebody else. Okay. So that's a limited life, all right? Whereas, corporations, all right, the way that they're formatted, they last for eternity, all right? That's as if they continue to be profitable, all right? But yeah, they have considered to have an unlimited life. A corporation, LLC, is considered to have unlimited life. As far as partnerships go, all right, one of the other characteristics is that they have an easier ability to raise capital or money, okay, than a sole proprietor, right? Because you may have some money, I may have some money, and really what we're doing is we're combining our money, all right, in our business, right? That's true, and it also is true with intellectual capital, right? So let's say that I have a real strong accounting background, go figure, whereas you might have a really strong tax, right? And so if we come together and form a partnership, all right, you can do all the tax stuff and I can do all the audit stuff. And we would be a better business together than we would be apart. All right. And so there's not only the ability to raise money easier, okay, we also have the intellectual capital. So let me hang on a second. Can you guys make sure that I'm trying to see, try to mute somebody here, but if you can, unless you have a question, if you can mute yourself so that we don't hear you blow your nose or something along that line. All right, I know there's a way that I can mute everybody. I just can't find it right now. So whatever. Moving on. In addition to the characteristics above, all right, there's the the co-ownership of partnership property. Okay, and really what that means is once we bring things into the business, all right, the business owns those things. Or another thing is maybe we formed a partnership, we've been running it out of our garage, all right, and then our business becomes large enough where we can actually buy a building, right? Well, that building, right, belongs to both of us because it's part of the partnership assets, all right? And so, that's not a problem until we decide to go our own way and we have to determine, well, who gets what, all right? There's another thing called mutual agency, and as I referred earlier to, a marriage, okay, that's that's really this scenario. All right, so let's just say that we're in a partnership together, all right, and I come to you guys and I say, hey, you know what? There's this really good piece of property on Lake Michigan. I think we should buy it because it's a really good price right now, and we could save it as an investment and maybe sell it later, or maybe I'll buy it from the partnership later once I get some more money and build my house on there. Okay. And you guys are like, no, I don't think we should do that. I don't think we should use our money, the business's money, to go and buy this land, right? But because I'm a partner and I have the legal ability to, sign contracts in the name of the partnership, right? I could go and buy that piece of property even though you told me not to, okay, in the name of the partnership. And then what happens, all right, let's say I die, all right, you guys, the remaining partners, still have to pay that land off, right? Because we purchased it in the name of the partnership, not in my personal name. Okay. And so you guys are stuck with it. All right. And that's this mutual agency. I can act as an agent of our partnership and enter into contracts, legally binding you to that transaction, even though you explicitly told me not to do it. All right. And so that's why it's very important, okay, to make sure that you can trust the people, all right, that you are involved with, all right, in any business, whether you set it up as a sole proprietor or not, okay, or not sole proprietor, but as a partnership or not. Then, the benefit, participation in income and the sharing of losses, all right. And so, again, what's important here is how we distribute that money, okay. And again, I told you earlier that, when we're trying to find things, all right, you're going to look them up in the partnership agreement. In fact, in this, negative thing here, kind of, you can put it in the partnership agreement that, there has to be a 2/3 majority vote or, something along that line before we can enter into any transaction. And so you may have some legal protection if you put it in the partnership agreement. Okay? When we talk about a limited liability company, this is a relatively new form of business, right? Last, 15 years or so. And it gives you the benefit, all right, of being a partnership along with that corporate shield or limited liability, all right? And so, it's been very popular, not only for small businesses, but medium-sized businesses also. All right, I have a rental property in Dowagiac. I actually put that rental property into an LLC so that I'm protecting if somebody were to get hurt or, at the property, they could sue and take that property, but they can't come after my personal assets. And so characteristics of an LLC, very similar to, as I said, a partnership. The big difference, all right, is this one right here. Okay, so this is the benefit. All right, only the members' investment, right, in the company are subject to the claims of the creditors. Right? Pretty much. Well, this one is also, okay, it has an unlimited life. All right, whereas the partnership has a limited life. And outside of that, they're pretty much the same thing. Okay. And so they just do comparison there. Definitely go through and read that information, all right, because I did a very quick job on that one. All right. So forming a partnership. All right, forming a partnership. Basically, we realize that we're better together than we are apart. Kind of sounds like what we're going through now, isn't it? All right, in forming a partnership, the investments of each partner are recorded in separate entries, journal entries. The assets contributed by the partner are debited to the partnership accounts. Okay. If any liabilities are assumed, all right, then they're credited. Right? The partner's capital, all right, is credited for the net amount, all right, or what I've referred to this as the plug. All right. If you remember, we have assets. Normal balance is debit, right? Okay. We have liabilities, right? And so, if we had, let's say, 14 here, okay, and we had 3 here, okay, then the capital, okay, has got to be 11, right? To make this thing balance, okay. But the trick is, all right, with these assets, okay, these assets are brought on, all right, at fair market value. Okay, and so it's not going to be just the business's debits and credits, combined, right? We're going to establish the fair market value of those assets. And so we have a scenario here. Assume that Joe and Earl decide to join forces. All right, they're both have hardware stores. All right, they agree to combine their business into a partnership. They may be doing this because Menards, okay, is building a building in their town. All right, and so small hardware stores have a hard time competing against the box stores, And so Joseph and Earl decide to join forces. Right? They do this because they get some benefits. Right? They can buy in bulk now. Okay, and maybe Joseph, all right, he's a a carpenter. Okay, and Earl is a concrete guy. All right, so they have specialties that they're able to join together also. All right, and so this is Stephen's. Okay, or Joseph's. All right, these are Joseph's assets that he's bringing to the partnership. Okay, I want you to know that they are the fair market values, not the historical cost. All right, and that is really true, especially when it comes to office equipment. All right, and store equipment. Okay, because as we depreciate those, right, the allowance for doubtful accounts, or sorry, not the allowance for, as we depreciate those, accumulated depreciation, right, on our books, they devalue, right? But that is not necessarily true. Equipment can hold its value or even get to be of more value, okay? And so we're going to bring these things on at, like I said, the fair market value. And so we're going to make this journal entry. Okay, we're going to debit all the cash, accounts receivable, merchandise inventory, store equipment, office equipment. Okay. Then we're going to record the allowance for doubtful accounts. All right, accounts payable, because this is a contra. Accounts receivable or contra asset account. Right? The non-cash assets are recorded, as I said, all right, at fair market value. They're what was agreed upon, okay, by the partners. All right. You know what drives this? Greed. All right. So if I was this guy Joe, all right, and I'm bringing my stuff, and I say, hey, you know what? I got this equipment. Yeah, the book value of this thing is zero. It's fully depreciated, but it has value. Okay. And so I want credit. I want to get value for it. I shouldn't have said credit. Confuse you guys, debits and credits, but I want to get value for this of $8,000. And you're like, I don't know. All right, you know why? Because you're selfish. I'm selfish. I want to get the best deal, and you want to get the best deal. Okay. And not until we agreed that my store equipment is valued at $5,400, right? We then established, because of our greed, we established the fair market value of that store equipment. You're willing to give up $5,400, and I'm willing to give up my asset for a value of $5,400. Okay. We do that with the office equipment also, and sometimes with inventory. Okay, and so they may not be the exact numbers that I have recorded, right, in my my historic or my old accounting records. Right, we're bringing them on at their fair market value. All right. Now, if this was an LLC, okay, let me highlight. Okay, first of all, the plug here. Okay, we established all the debits and we established all the credits. All right, and so we came up with this $56,000. All right, that hey, everything that you're bringing to the table, all right, or that Joseph is bringing to the table, is worth $56,000. All right, looks awfully similar. All right, it's just now we're going to have one for Joseph and one for Earl. Okay, we're going to have two capital accounts. And that's really the biggest difference between a sole proprietor and a partnership. Now, if we're doing an LLC, the only thing that is different, instead of being a capital, it's called members' equity. And so again, we'll do the journal entries for the LLCs, but I will cease to talk about them, all right, because it just slows down. So we're going to get to the dividing of income. And so I'm going to make a break here and stop recording. And then I'm going to pick it up again right away.